Good morning and welcome to the Center for European Studies Fall Lecture Series, The Euro Crisis and Beyond, here at the University of North Carolina at Chapel Hill. My name is Justin Chandler Wilcox.
And my name is Benjamin Thorne, and we're both students in the Transatlantic Master's Program. Joining us today is Professor Layna Mosley, who studies and teaches international relations, international political economy, and comparative political economy. She received her PhD from Duke University in 1999, then moved on to teach at the University of Notre Dame, and now she is here where she belongs at the University of North Carolina, Chapel Hill. Her current research projects examine the effects of international capital mobility on government policy choices, the role of private sector actors in global financial regulation, and the relationship between labor rights and foreign direct investment.
It is no exaggeration to say that the European financial crisis has dominated our studies this semester. The Eurozone is the perfect example of European integration and how the integration is piecemeal and lacking in cohesion in that of a normal nation state. So today we will learn about the crisis and just how these sovereign these governments' debts are in this area in which they've given up sovereignty of their currencies. And so to discuss this issue, the sovereign debt crisis, please help us in welcoming Professor Layna Mosley.
Thanks very much for the nice introduction. So today we're going to talk a bit about financial market government relations, and specifically about sovereign debt markets, that is the markets in which governments borrow money, and how sovereign debt affects governments' policymaking autonomy. And in terms of thinking about the European debt crisis, what I want to do is think about how the European crisis allows us to think more generally about what we know as academics, and also in a policy sense, about sovereign debt and how sovereign debt markets affect government policy making. So what I'm going to do, is start by talking a bit about what the European crisis might lead us to in terms of lessons. I'm going to mention three main lessons today that come out of the European crisis that are not directly maybe evident from the crisis, but allow us to think about how we've thought about financial market government relations and how we might need to revise that sort of thinking. So my talk is going to be a little bit based on my research as well as research of others, but also somewhat based on policy. And if you have questions along the way, feel free to raise your hand, interrupt me. I'm happy to take them during the talk, or of course to take them afterwards. So with respect to the European Union, what we know is that from the beginning of the last decade, there was a convergence of interest rates among government borrowers in Europe. So that is that once they joined the single currency, Eurozone members enjoyed a pretty dramatic fall in some cases in their cost of borrowing. So that is in the interest rates they paid on sovereign debt. It's kind of this virtuous circle in which investors saw these governments making changes to qualify for the single currency. In response to those changes, investors thought, okay, well, these places are going to be less risky places to invest. Interest rates fell. As interest rates fell for these borrowers, they had to pay less money to service their old debt, and this allowed them to spend even less and have even smaller deficits. So it's this kind of, again, this virtuous circle in which initial falls in borrowing costs lead to less government spending, which lead again to further falls in borrowing costs. So from the point of view of sovereign borrowers in the late 1990s, early 2000s, EMU was a real boost in terms of accessing international capital markets. Part of this, of course, is that investors assumed that there was really no risk of default by EMU as well as EU and actually developed countries more generally, government borrowers, right? So the issue here was that even if these governments presided over inflationary periods, or even if their government budget deficits increased, these were governments that would always repay their debt, right? So the idea of default was really not something to worry about. Now, in the European Union context, part of this belief on the part of investors was a belief that other EU members, especially Germany, or the EU collectively, would never allow any Eurozone member to fail, right? And so even though the Maastricht Treaty had a clear no bailout clause in it, investors sort of thought, there's no way, if push comes to shove, they're going to allow a member to go into default. And of course, that has played out. There was, as you may know, after the single currency came onto the scene, this Stability and Growth Pact, which served to require governments to keep their budget deficits low after EMU. Okay, so the idea was that governments made a bunch of reforms to get deficits low to qualify for the single currency. The concern was once they were in, what was going to constrain them from sort of running deficits again, and the answer was to have this thing called the Stability and Growth Pact. And the way it worked was if your deficit was deemed to be excessive, that is over 3% of GDP, then there was a series of sort of penalties, right? So there was a kind of this investigation. If the economics and finance ministers found you to be in violation, you'd get yelled at publicly, and then if you still were in violation, you'd get fined. What's interesting is that as early as 2004, governments violated the Stability and Growth Pact and were found to have excessive deficits. Financial markets responded very little to this, right? And part of the story is that the violators were not only countries like Portugal, they were also countries like Germany and France, right? And so I think part of what went on during that first decade of the euro was investors really believed it was going to work, and they kept believing that they didn't have to worry about the risk of default among all these Eurozone borrowers. And so if you think about what this meant for governments, it meant that they were first of all, it meant they were able to borrow cheaply, and I'll show you a picture of that in a second, but it also meant that markets were really kind of following governments' suggestions, right? So when governments said, as they had said in the early 1990s in the Maastricht Treaty, and as they said again with the Stability and Growth Pact, when they said, we think 3% of GDP is the cutoff for a sort of acceptable fiscal deficit, markets kind of followed along. Okay, so markets certainly responded to news that Italy was going to be over or under 3%, but that was a rule that was not based very much so much on markets' reasoning. It was based on markets cared what governments were going to do, and so governments kind of got to suggest rules to investors, which is kind of interesting because we think often about investors limiting governments, but here it was governments kind of setting rules and investors responding. The other thing is that we see, this is across the OECD, but we see that the interest rates on government bonds, these are just kind of standard, what's called a benchmark government bond, so it's a 10-year maturity and it's in domestic currency. And all you sort of want to look at here, this is both kind of old OECD as well as more recent OECD members, you just see there's a big drop in the cost of borrowing over time. And then, of course, more recently, a big spike with the crisis in Europe. If you want to take just the more recent period in just a few European countries, you see, of course, the kind of low rates anyway. So that's one thing to keep in mind, at least up until 2008, 2009. But also a real narrowing of rates. So the Italians or the Greeks only pay maybe half a percent more than the Germans to borrow money until the crisis hits. And then, of course, things blow up in 2009 and after. Okay, and so the other thing that happens in Europe that we're going to think about is that as the crisis hits, part of what happens is that investors begin to pay more attention to differences across countries, right? To thinking that Greek government debt and German government debt are not the same thing, and as part of this, they pay more attention to default risk. Okay, they begin to worry that in fact maybe European governments could default. So to the extent that governments got a reward in international capital markets from being members of EMU, this reward is really reduced, and maybe for some countries even goes away altogether. So this chart just shows us the variance, okay, among all OECD countries in government bond rates over time. And the thing to sort of note here is that prior to EMU, okay, 98, there's a lot of variance. And then as the single currency gets underway, the variance really falls. And then, begins to increase back up a little bit in 2005 and 2006, but of course it really spikes back up in the last couple of years, right? So there's an increasing differentiation among sovereign borrowers, even within the developed world and even within EMU. Okay, so all of that is meant to motivate the rest of the talk and to think about the lessons we might learn from the European Union economic crisis generally and debt crisis specifically. So one thing is, and I'll come back to this in a little while, but my earlier work my first book was on the link between sovereign capital markets and government policy making, and it compared the extent to which developed countries, including European countries, versus developing countries or emerging market nations were constrained by international capital markets. And one of the big findings from that piece is that investors really weren't paying much attention to default risk in the developed world. They cared about inflation risk, maybe currency risk, but they really trusted that governments would repay their debts. And as a result, they sort of left governments alone in terms of worrying about things like corporate tax policy or welfare state programs or sort of active labor market policies, these kinds of more sort of supply side and micro level policies. Okay, so part of the story was that because investors were not attuned to default risk in developed countries, governments had more room for maneuver, more policy autonomy. And there was a contrast with developing countries where default risk was seen as very salient, right? And what I would say about the European crisis first is that it may well be that investors have become attentive to default risk anywhere in the world now, right? That is, that the idea that a European government could default is certainly much more on the table than it was a few years ago, okay? Even though we haven't actually had a real sort of everything falls apart default. This idea that, just because you're in Europe, you're a safe bet seems to have gone away to a large extent. And of course, I don't think anyone thinks that the U.S. is on the verge of default. But these questions about the U.S. credit rating, these kinds of things, also might play into this kind of increasing concern among investors that governments of developing countries may not be completely safe investments. Okay, so that's one, and I can say more about that if you like. But the second and third things are things I want to talk about in more detail. And the second one is that when we think about government debt, okay, what we tend to think about is how much governments borrow and how much they owe, right? So we say, well, the debt to GDP ratio in the U.S., nearing 70%, which is really high by historical comparisons. That's the number we know, okay? Or we think about, debt to GDP ratios in some Southern European countries of 110 or 120%, and we say that's really bad. Okay, and what we don't think about as much as political scientists or as just sort of observers of the situation in Europe is how that debt is comprised, right? That is that not all kinds of government debt are created equal. And I'll say more about this in a second. But the idea here is that some government debt is long-term, some is short-term. Some government debt is held by residents of your country, much is held by non-residents. Some is held by official creditors, that is other governments or other central banks. Some is held by private investors. And especially once you get outside of the core developed countries, some debt is denominated in your own currency, whereas some is in foreign currencies like US dollars or in some cases like euros or yens. All of this stuff, okay, all these features of the pool of public debt seem to have implications for how much policy autonomy governments have, right? That is, for instance, if you have to refinance your debt more frequently because it's more short term, you have to sort of face the market more regularly. And in that sense, if markets are upset and you've got a big chunk of debt coming up to roll over, you're in more trouble than if markets are unhappy, but your financing needs are not really that dramatic at in any given month or any given year. Okay, and so and let me just say that this stuff is really boring, right, in some ways, right, and really technical, right, and this is not, maybe one reason why academics or political science haven't paid much attention to debt management is it just seems so dry, right, and so the case I want to make is that yes, right, it is in a way, but it also is the kind of thing that really does have implications for how much autonomy governments have vis-a-vis markets, and so it's something that we ought to pay attention to, even if at first glance it seems not the most exciting thing. So one way in which government debt varies is based on sort of the maturity profile of the debt, right? That is, have governments borrowed short-term or long-term? What governments sometimes think about, and debt management agencies think about, is that it's usually cheaper to borrow short-term than to borrow long-term. Okay, so if you're going to issue government bonds that mature in 2 years or 3 years, you'll pay a lower interest rate than if you issue government bonds that mature in 10 years or 15 years. You have to pay investors more on an annual basis to give you a longer term loan. So that's the cost trade-off. The flip side, of course, is if you borrow short-term, what you need to do then as a debt managing government is roll that debt over more frequently, right? That is, your 2-year bonds mature and either you have the money to pay off the principal, but if you don't, as governments often don't, you have to issue new debt to replace that. Okay, so you have to more frequently face the market, ask to borrow money in private capital markets, right? And so if you borrow short term, it's cheaper, usually. But if you borrow short term, you also expose yourself more to this kind of rollover risk. And what you see in Europe is there's big variation. The British love to point out that their average term to maturity of their outstanding government debt is over 14 years, and this is really an outlier among Europe. The example I have here is Ireland being just under 6 years in 2010. If you're really interested in this stuff, you can find data going back into the 80s from the OECD. But just a snapshot from the last year for which the data are available just gives you a sense of the variation across countries among some of the OECD countries in terms of the average maturity structure of outstanding government debt. Okay, so we see quite a bit of variation, and you also see, if you look over time, also some variation. So this is again an OECD-wide sample. This is kind of all the countries in the sample, looking at sort of what the median is, and then sort of what the distribution looks like. So that yellow line is the 75th percentile of maturities, and the dark brown one is the 25th percentile of maturities. So what you see here is that there were more differences across countries in the late 1980s than there are today, but there's still quite a bit of difference across countries. You see, on average, the maturity has gone up by a little bit over time. But again, there's a lot of variation in terms of how governments manage this debt, or how they make that trade-off, right, between sort of cost and rollover risk. Okay, and then just to give you a more recent sort of picture, if OECD collects information in terms of how much debt governments are going to have to roll over in the very near future, right? And so these three bars are this year, 2012, 2013, and 2014. This is a percentage of debt that the government is going to have to refinance, right? That is, this percentage of the government's debt that's maturing in a given year. And you can see here, if you look in terms of the euro area, right? This is total debt, and so this year, about 20% of euro area debt needed to be rolled over. You see again for next year, just over 30%. And then sort of the following year, almost 40%, right? So there's going to be a lot of need among countries in the Eurozone to refinance their debt and to face the markets. And again, it really does vary across countries as well. But one of the things the OECD was sort of pointing out is that in terms of their long-term debt, OECD governments are going to have to refinance about 30% of that debt during the next 3 years, right? So the idea is that if financial markets are really worried about default risk, okay, if they're really nervous about making new loans to governments in OECD countries or in EU countries, that rollover is going to cost governments more money. And what that means is going to be higher interest rate charges, so either sort of less money to spend on other kinds of programs or bigger budget deficits. And so that really is why thinking about maturity might be an important thing to do. Very last thing on this, because I know it is not the most exciting thing in terms of looking at the data. And I know you also can't see these little labels. These are OECD countries, just a snapshot again, comparing the average time to maturity in 2007, so before the global crisis, and then in 2010. And so anyone who has a black diamond inside their blue bar has seen their maturity fall during the crisis, okay? And anyone whose diamond is above has actually seen their maturity lengthen during the crisis. And so if you want to know, this is Mexico in terms of that jump, and this is Chile and Denmark and Finland. Okay, so European countries have been more in the sort of, it was longer before the crisis, it's shorter now as markets are more worried about default risk. And I'll make these available so you can look at them later if you want. Okay, so that's the first part. It's just kind of this idea of debt maturity and rollover risk. And I'll come back to thinking about what actually drives that in a minute. The second thing to mention is that debt varies in terms of who holds it. So one thing that's true is that, especially for countries that are big issuers of debt and whose debt is seen as a kind of benchmark instrument, one of the main holders is often foreign central banks. So just to kind of flag this, much of the U.S. Treasury debt, U.S. government debt that's held abroad, okay, is held not by private investors abroad, but by foreign central banks, okay, including, but not only, the Chinese central bank, the Korean central bank, the Russian central bank. All of these central banks want to hold dollar-denominated bonds because they want to have dollars because the dollar is a key global currency. So maybe the U.S. benefits unreasonably, right, from the dollar's role. I think what's interesting about that, though, is that these foreign central banks tend to be very patient. That is, they're not sort of going out and engaging in day-to-day trading on government bond markets. Okay, they're more content to kind of hold on to these U.S. government bonds. And so in some ways what that does is that allows the U.S. government a little bit of a cushion, right? So the U.S. gets away with more because of the role of official creditors who are sort of, maybe more patient than private investors. So that's part of it. But the other part of it is that it's long been the case that some European governments sell their debt mostly to their own citizens, whereas others sell it mostly to foreigners. With the single currency, okay, governments in general move towards selling more debt to non-residents, right? Because suddenly, if you're a German, you don't mind buying a Belgian or an Italian bond because there's no currency risk, right? But even with the single currency, there's still some variation in terms of who holds the debt. So again, in 2010, 94% of Greek government bond was held by non-Greeks. And you can compare that to 56%, okay, of Italian debt being held by non-Italians. There's this old phrase, people used to talk about Italian grandmothers and Belgian dentists, right? Because Italy and Belgium, across their high debt years, would frequently say, yes, we owe lots of money, but we owe it to other people in our country. And they're more patient. Okay, so the implication is it might be that resident investors, okay, have maybe longer time horizons, maybe better information, or maybe they're just more willing to trust their government, maybe they get better tax treatment. But that for some combination of reasons, resident investors are often more patient, less likely to kind of punish governments for negative news than are non-resident investors, right? And so again, you might think that difference in terms of resident versus non-resident holdings of investment is going to really matter for governments, especially if they get into a crisis. And again, if you want to look at sort of a picture of that, these are 2009's latest data available here, but you can just look and see what percentage of public debt is held by non-residents. And of course, again, you see, small countries tend to have fewer resident holdings of debt because they have a smaller pool of capital. But even once you account for country size, there is quite a bit of difference across countries in terms of resident versus non-resident holders. And again, if you think that residents, for all sorts of reasons, are more willing to kind of sit through bad times, or they're less willing to punish their own governments for negative policy news, then this is going to make a difference. And again, part of what you see in the OECD is that the general role of non-resident investment goes up over time. That's largely an effect of the single currency, where people are more willing to hold other EMU nations' debt because currency risk disappears after '99, so you see a real spike there. But again, we still see these persistent differences across countries in the OECD and in the EU in terms of resident holdings of debt. Okay, the final sort of boring component here of debt management is one that's maybe a little less relevant to EMU countries and more relevant to emerging market or even sort of peripheral European or sort of prospective EU member countries. And that's the question of how debt is denominated. That is, in which currency does a government issue debt? So among wealthy countries, where investors were not very worried about default risk, they also tended to not worry so much about currency risk. That is, investors tend to not worry much about, oh my goodness, the German mark is going to crash against the dollar, and we'll be holding mark-denominated bonds, and they'll be worthless. You can imagine, though, that an investor might think that about, let's say, the Mexican peso, right? If I buy peso-denominated Mexican government debt, and the peso collapses, right, then I'm left sort of holding these assets that even if they get repaid, even if there's no default, they're worth so much less. And so many people have pointed out that just by virtue of kind of being developing countries face this problem of having a really hard time convincing investors to buy bonds that are denominated in their own currencies. So this is Barry Eichengreen and Ricardo Hausmann call this original sin. Okay, and what they mean by this is even if you're a developing country that hasn't screwed up your economy, even if you do a good job managing your economy, investors tend to demand that you issue debt that's denominated in foreign currencies. So if you're the Mexican government and you issue a dollar-denominated bond, this means, right, that people who buy that bond don't have to worry about currency changes. Okay, they don't have to worry about the peso losing value against the US dollar. But it means that you, as a government, have to worry a lot about this because you have to generate the dollars you need, right, to repay this debt, right? Because no matter what happens to your peso, Okay, what you owe is in dollars, right? And so what this really does is it takes away the risk for investors in terms of currency risk, but it puts this risk on governments, right? A government whose currency collapses, or a government who has a big trade deficit, okay, has to work hard to generate the dollars or the euros or the yen it needs to repay its debt. And so what we find is that developing countries have often faced pressure to issue foreign currency debt. And that foreign currency debt where governments have a choice is cheaper, that is lower interest rates than domestic currency denominated debt. Yeah?
Can you get away with it if you peg your currency to another nation's currency?
You can get away with it if investors think that your peg is credible, right? So, I think the issue for a lot of developing countries in the 90s was that there was a distrust in whether or not these were the right pegs, right? So, if the worry was that the peso is pegged but it's overvalued, and then, well, eventually there's going to have to be a devaluation, right? You still have that currency risk issue. So countries that have had what are known as currency boards, right, where the peg seems really, really tight, they get away with this thing more easily than other countries. Anybody else? Okay, so that's not what I'm going to talk a lot about for the rest of today because it applies less to EU countries, but just to sort of know that it's out there as well. Okay, so I said before that this is stuff that people don't pay much attention to. We hear in the press sometimes kind of, Italy has to roll over some debt this next week, and so what happens in the political negotiations with Italy and the ECB or Italy and the IMF is really more important now because there's this auction coming up. So we see it sometimes kind of out there in the media, but there hasn't been much of a systematic analysis of sort of why there's this variation in how governments borrow money. And of course, one possibility here is that governments borrow the way they do because they have to, right? That is to say that if you have high debt, you have a history of high inflation, it may well be that investors are not going to lend to you long term, right? Or the cost at which they would lend to you long term is just too high. So it's possible, of course, that to a large extent these debt management outcomes are endogenous to kind of macroeconomic characteristics, macroeconomic histories, right? So one question to ask, right, is how much of these outcomes is actually explained by economic factors versus how much is left we might explain with different kinds of political factors. So if we think about debt management outcomes like maturity structure or resident holdings as a dependent variable, the question is kind of what explains them. The second kind of bigger question, of course, which I'm not going to, I have a sense that it matters, but I don't have much evidence yet, is kind of what these debt management outcomes mean for government policy-making autonomy, right? So, to what extent does a government that has a longer maturity structure of its debt sort of get to do more stuff, right? That is, to what extent can it sort of act with less worry about being punished by capital markets? And so in that way, we can think about debt management outcomes as an important independent variable that might help to explain government policy choice, where variation in those outcomes can lead us to think about what governments are able to do vis-a-vis markets. Now, the other thing I'll say here is that a lot of governments in the 1980s and 1990s began to pay more attention to debt management, right? That is, they began to sort of think more systematically about, okay, there are these trade-offs, and we should maybe have professionals in place who are going to think about how best to make these trade-offs. And so what you have is these sort of separate debt management offices being formed in a lot of places 20 or more years ago. Some of these are headquartered in the Ministry of Finance. Some are in the central bank. A couple of them are just standalone entities. But you have more sort of attention to this as an institution than you had in the past. Some of these debt management offices function very autonomously from governments, so they're supposed to be kind of like politically independent. Some of them have a mandate that says, whatever you do, keep our borrowing cost very low. Other mandates say, keep borrowing costs low, but don't expose us to too much rollover risk, so kind of sort of mediate between the two. Okay, so there's variation in the institutional structure. And in developing countries, you see the same attention to forming these kinds of management offices in the last decade. What developing countries actually did in the mid-2000s was there was a lot of money floating around in global capital markets in 2004, 2005, 2006, right? So investors, this is part of why we got that nasty housing bubble. So what governments did in places like Brazil was to refinance much of their debt and to move from foreign currency denominated debt to domestic currency denominated debt. And this was partly these debt management offices saying, if we borrow in foreign currencies, we are exposing ourselves to currency risk, and so we ought to sort of take advantage when there is global liquidity of the ability to kind of transform some of our debt. But the big trade-off, right, that these debt managers face is the trade-off between the cost and the risk. Okay, and here I mean the risk to governments, right? The risk of having to generate foreign currency, the risk of having to roll things over more frequently, and then of course the cost in terms of having to pay more if you're going to borrow longer term and in your domestic currency. Okay. So, without going into too much detail, right, because it's Friday afternoon, I've done some work looking at some of these debt management outcomes, both maturity and resident investment, as dependent variables in a statistical analysis, where I pull together OECD countries and look at how economic as well as political factors seem to correlate with debt management outcomes. And so the data I use are based on sort of when the OECD actually measures these outcomes. So they start doing this in the early 1980s. And the number of countries ranges based on data availability. This is all kind of inside the OECD. So just to give you a little sense of this, if you have a history, and this is true if you have a history over the last 3 years or 5 years, doesn't matter. If you have a history of inflation, then you tend to have a shorter time to maturity of your debt, not surprising. If you have a history of government budget deficits, as well as total government debt being high, you also tend to have shorter maturities. Okay, so the idea that economic factors contribute to how you manage your debt is certainly one that's supported by that evidence. It's also interesting to note that countries that have a higher number of effective political parties, so more political fragmentation, seem to have lower debt maturities. You can think about some different stories about why this might be the case. You can imagine if you have frequent government turnover, frequent worries about turnover, that different political parties may think, well, we can accumulate debt and tie the hands of the next people in power, is one argument that's been made. It's also true that if you have a politically independent central bank, you're more likely to have a longer debt maturity, although that finding is a little bit less robust. So there may be something going on here with domestic politics and debt outcomes. In the interest of full disclosure, though, I'll also say that government ideology doesn't seem to really predict time maturity of debt, nor does it seem to matter if you've been governed by a single party versus by a coalition government. So the idea of sort of political fragmentation being a story about coalitions doesn't seem to be borne out. And of course, interestingly, there doesn't seem to be much of a link between years in which a country is a member of EMU and a country being an EMU member and debt management, right, and time to maturity, right? So maybe this is because there aren't enough EMU country years in this data to give us that, but in any case, the EMU in and of itself doesn't seem to make a difference, nor does it seem to matter whether or not your debt management office is a separate entity. So what do you make of this? Well, it's hard to know, right? So we've got some evidence that says that economic factors matter some, but also that there's probably something else going on. And what I'm working on a little bit now is doing some work to actually think less about the average maturity structure of debt and more about specific issues of government bonds, right? What maturity structure data do is they pull together, right, all the debt that's out there and say, okay, on average of all the debt of Belgium, or the Belgian government, what's the average time to maturity, right? And so it's a nice summary statistic and it's easily available. The downside, right, is what we really want to know is, on a given Wednesday, when the Belgian government has to decide if they want to borrow money or not, how are they able to structure it, right? What do they try to do? Do they try to go for 5-year bonds or 10-year bonds? And how much of that is determined by they're still trying to form a government, or they have this debt, or investors are sort of unwilling to hold long instruments, right? And so I think one way forward here is to think about the dependent variable not as kind of the summary of debt maturity, but actually as more of an individual issue kind of thing. And that might get to more of the strategic interaction between governments and investors. So for now, I think the take-home point is to say there's lots of variation in these kinds of outcomes. They do, I think, have implications for what governments can do vis-a-vis financial markets. but we don't really have a good sense of where they come from, and really even of how specifically they affect government policy making. So that's the kind of first, I guess, sort of work in progress kind of thing. Okay, so the other thing I want to mention today, and so I should say all of that stuff about debt management is stuff that kind of relates to the one reading I circulated, the short sort of foreign policy piece from this summer. So that's how that sort of ties in. The second sort of big thing here, which will be my third thing on my list, is this idea that when investors are deciding where to invest, okay, when they're assessing countries, okay, the ways in which professional investors assess sovereign borrowers, they vary across countries. So I mentioned developed versus developing countries. They also vary over time. So there are some periods, right, of sort of global enthusiasm in capital markets, and even countries that look really risky can get money at low rates of interest. Other times, when there's sort of risk aversion in global capital markets, even governments that seem to be sort of pretty together have a hard time getting capital. So we know there's variation across time and across countries. But I would also argue, right, that there's variation in terms of how investors assess sovereign borrowers that comes with respect to how they classify, how they categorize sovereign borrowers. And this is the topic of the paper, the longer paper I circulated, which is joint work with Sarah Brooks, who's at Ohio State. Okay, so what we're doing, and I'm not going to give the whole, I could give you lots of slides on this, but in the interest of time I won't, but there's a lot more in the paper. But what we're sort of trying to figure out is there's this broader question about when investors are thinking about sovereign debt, they're thinking about what to buy and what kinds of interest rates they're going to demand of governments. What do they look at, right? Are they looking at default risk? Are they looking at sort of certain kinds of economic policies? And again, as a political scientist, the reason to care about this is not that I want to go out and make lots of money investing in government bonds, right? Because if I could do that, I probably wouldn't do this, right? But, right, is because if we think that markets look at certain kinds of things, then if we think that governments pay attention to market pressures, that's going to give us a sense of the ways in which and the degree to which governments are constrained, right? And so the question here is, what's really motivating investors? And I mentioned, of course, already that professional investors tend to worry about default risk, inflation risk, and currency risk, but they tend to worry much less about default. They have tended to worry much less about default risk in developed countries. They tended to sort of assume away default risk, at least up until the European crisis, and instead look at things like budget deficits and inflation. In the developing world, on the other hand, of course, investors have tended to look more broadly because they're worried about default, and so they look at sort of the allocation of government spending across different functional areas. They look at, is it a left government, is it a right government, what does the upcoming election mean, so that sort of micro level or supply side policies as well as political factors seem to play more a role of driving interest rates and risk premiums in developing countries than in the developed world. Although, of course, with the caveat that this may change with the European crisis, right? So, actually, let's just skip this. All of that slide basically said, so historically, developing countries have faced more constraints from international capital markets than have developed ones. And I can come back to that if you want to hear more about that. So what we know, lots of work that tells us that the cost of borrowing to governments varies quite a bit across countries as well as over time. We also know, right, that it varies across sort of, whether you're developed or developing. Also, if you're a commodity exporter as opposed to a manufacturer's exporter, then you tend to face more volatility in global capital markets. We also know, have some evidence that if you borrow your money from banks versus from bond markets, you face different constraints. So we know there are all kinds of ways in which the kind of global capital market constraint facing governments is actually quite different across governments, right? So, the earlier part of the talk was how debt is kind of different. Okay, this is how sort of, governments are different in terms of how constrained they are, okay? So there's more variation than meets the eye. So what we are talking about in this paper then, okay, is, all right, we know that global market conditions affect government's cost of borrowing. And we know that country-specific characteristics like inflation or budget deficits affect the cost of borrowing. And then we want to know, is there some other third thing that also matters? Okay, so in that paper we talk about, is sovereign debt really sovereign? What we're really saying, right, is to what extent does the price that a government pays to borrow money depend on its own policies, okay, so things that are internal to that government, versus on things that are external. Okay, and again, we know there is external stuff that matters. For developing countries, it could be things like sort of the extent to which there's liquidity in global capital markets. It could be the price of import and export commodities. What we want to think about is something else, and that is this idea, right, that investors put countries into categories. Okay, so this is the idea that professional investors have a lot going on. Okay, they're using heuristics to try to sort out the world. Most professional investors are managing portfolios that contain a lot of different assets, so stocks, bonds, derivatives, all these things, and also assets from multiple places, lots of countries worldwide. And so investors are kind of looking for kind of shortcut devices or cognitive heuristics that help them sort of make quicker decisions on less information, right? So sort of the question is sort of, can I be almost as good of a decision maker with much less information as opposed to finding out a ton of stuff about each and every country, each and every asset that's out there? So what we argue is that one way investors do this is to categorize countries, this idea of country classifications, right? And so you say, Brazil is a member of the BRICS, okay, and I have a pretty good sense of what BRICS are, how risky they are, what their prospects are, right? Or Brazil is a member of Latin America, and I have a pretty good sense of what Latin America looks like in terms of kind of the political features as well as the sort of how it fits into the global economy, what its prospects are long term, right? And so the notion here is that, you know, depending on where I put Brazil, in the BRICS or in Latin America, I might assess Brazil differently, right? And so if I think, you know, if I'm sort of sorted to the BRICS and I have a positive story about all BRICS, Brazil might do pretty well in terms of paying low interest rates. If I stick Brazil in Latin America and I think, well, Latin American countries are kind of like, you know, all these left governments and then like they default and blah, 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 not so good for Brazil, right? So the idea here is that these country classifications are shortcuts for investors, but they might sort of, let's ignore that. They might sort of not, you know, be the best thing for governments, right? So if you're classified with a set of countries that are perceived negatively by investors, you're going to pay higher rates of interest. If you're classified with a set of countries that are perceived positively by investors, you're going to pay lower rates of interest. Okay, so it could be a good thing or a bad thing from the point of view of sovereign borrowers. To give you a nice example from the EU, right? Back in the 1990s, people talked about Greece as a member of this thing called emerging Europe, right? We see that the OECD still uses that term. So you know they were in the periphery. They were an EU member, but they weren't quite good enough to get in that first big wave of EMU. And so you know whatever, right? I mean you can invest there, but they were treated more almost like an emerging market country of Latin America or Southeast Asia than a member of the European Union. As soon as they join the European Union, of course, they get bumped into Eurozone, right? And that recategorization, right, has a lot of benefits because there's this assumption, right, that Greece is one of those super safe, nice countries that have the single currency, right? It's not entirely kind of exogenous to what Greece did, right? They did things, or they said they did things at least, right, to qualify for the single currency. But it does lead to a big break in how they're treated in capital markets. Now, if you fast forward a few years to the European crisis, right, suddenly we have this other new category that investors come up with to describe part of Europe. On, you know, it's either the peripheral European countries, right, and that's bad, or it's the pigs, right? So Portugal, Ireland, Italy, Greece, and Spain, right? And there's this idea among investors, right, that these countries all sort of have these issues, which is interesting, right? Because we know that the roots of the crises in these different countries, right, in Spain versus Ireland versus Italy or Greece or Portugal, are all quite different, right? But there's this kind of shortcut about, oh, okay, you're one of those countries, right? And so, you know, depending on you're in the Eurozone or you're a pig, okay, these can be good things or bad things for sovereign borrowers, right? And so the idea here is that, you know, these categorizations can be either leading investors to being sort of overly optimistic or too pessimistic about a given sovereign borrower. So what we want to think about here, right, is the extent to which sovereign risk assessments, okay, move not only because of country-specific factors and global financial market factors, but also because of these kind of peer group things that are going on, right? And you know, this is a, you know, necessarily want to get into a big debate about how markets work, but part of the implication here is that markets are not efficient, right? Which probably isn't surprising to anyone post-crisis, right? But that investors don't have the same response function to a given domestic policy. It varies over time. It might not be fully objective. Okay, all right. So we have kind of two things we test out. I'm not going to go into the data. I'm just going to tell you what we find. So one is that even once we account for global economic factors as well as for country-specific factors, we expect that the risk premium of others in your category will be a significant driver of your own risk premium, right? And so again, if you're in the EU and investors are generally negative about the EU, okay, you're gonna get part of that negativity. If you're in the EU and investors are generally positive about the EU, you're gonna get part of that sort of positive bump. We also, and that's the first idea that we have in this paper. The second one is that when investors are evaluating individual borrowers, they're not only thinking about how are you doing in absolute terms with your deficit, they're also thinking about how are you doing in relative terms with your deficit, right? So in a year when every government in the European Union is running a 6 or 7% fiscal deficit, a deficit of 5% actually isn't that bad. In a year when everyone has 1 or 2 or 3% of GDP as their deficit, 5% doesn't look so good, right? And so the idea here is that, in the other part of the story, is that investors' assessments of governments are relative ones, right? It's not just how you're doing on policy, it's how you're doing relative to others. And when we think about others, again, we're thinking others in your same country category. Okay, so that category comes in two ways, right? As a kind of transmitter of risk premiums, but also as sort of a relevant kind of comparison group for investors, okay? And so the second hypothesis here is that sovereign risk premiums ought to be linked with what others in your category are doing. So for instance, if other countries have high debt, right, then maybe it's the case that markets will be less responsive to you having kind of moderate debt. If others have low levels of debt and you have moderate debt, you get in trouble. Okay, so let me just kind of wrap up real quick because it's getting late, and say when we think about how to categorize countries, we have some different measures. So one is just a really basic geographic region, comes from the World Bank. The second are these kinds of categorizations that professional investors use to sort countries into emerging, developed, frontier markets, or one that's a little more sophisticated, but basically kind of sorting out countries in terms of their market and economic development. And the third is we sort countries according to their sovereign risk rating. So we put all the AAA countries together, all the the sort of AA, and on down the line. Okay, so we think about different ways of operationalizing these categorizations used by professional investors, because our experience, sort of qualitatively, is that there are these sort of different ideas floating out there among private investors in terms of how to think about categorizing countries. So without going through any of the data, which I will make available on the slides, I'll just say that one thing we find is that over both the short and long term, the interest rates or the spreads that governments pay when they borrow money do seem to be associated with what others are doing, with what's happening to others in their category, right? So what this chart does is, if there's a blank cell, it means that we don't find a statistically significant association between the kind of peer group risk premium and the country's risk premium. If there are words, it means that we do. And so the way we estimate this statistically is it's a model that allows us to see both short-term and long-term effects on risk premiums. That's why they're both here. What you see is that most of these categories, especially geographic region and credit ratings, seem to be a transmission mechanism for financial markets. And so again, the kind of takeaway point here is that country risk premiums are determined not only by what a country does and what goes on in global markets, but they're also determined by what goes on in countries' peer categories. And for European Union countries, I think this means that if the general sentiment is that the EU is screwed up, right, that's going to travel to all EU countries, right, even those that have done pretty well in the face of the crisis. The flip side, of course, and that part really isn't in our data given when it ends, The flip side, of course, is that if there's enthusiasm about the Eurozone or the EU more generally, that's also going to travel across countries, even those that aren't doing quite as well. So this isn't to say that governments always get punished by virtue of being in certain categories, but it is to say that the way in which you're categorized does make a difference, even over and above your country-specific outcomes, right? So it's really an extra thing that's there. The other thing that I want to mention is that when we think about whether or not governments are assessed in relative terms, what we find is that the level of debt in your regional peers, so among other countries in Europe, let's say, is negatively and significantly linked with your spreads, right? So that is to say, okay, a country with higher debt of its own pays more, makes sense. But if other countries around you, okay, other countries around you have low debt, okay, you tend to sort of get a bonus, right? So in some ways here, there's this weird thing in which if you can sort of look better than everybody else, if you outperform, that is, here you have lower debt, you get a bonus, right? And so this is a story that maybe says, if you have the nicest house on the block, that's a good thing, right? So, or, if you're, with a bunch of loser indebted countries, you actually get evaluated better, right? You're not as bad as Italy or Greece, therefore you're not so bad, right? Investors have to put their money somewhere. But if you then look at sort of what drives sovereign credit ratings, it's the opposite, right? So when other countries in your sovereign credit rating, like AAA category, when they do better in terms of fiscal deficits or fiscal balances, you also do better, right? So that's the kind of rising tide lifts all boats. If your region is really performing well in terms of not having big deficits, you also get a boost, okay? So I have no idea what's going on here, right, is the kind of full disclosure part of this, which is to say that we have these findings that suggest that what's going on among your peers in terms of their economic policy outcomes also has an effect on your risk premium, but there seem to be two stories at play, right? One is the story that if you outperform your peers, you get a bonus. The other is if your peers are all looking good, you also get dragged along, right? We've got one finding for government debt, a second finding for fiscal deficits. So I don't think we have a kind of full story here in terms of how the second hypothesis really holds up, but I think we have some interesting stuff. So last slide. Again, when we do these analyses, if you happen to look at the paper, what you see is that we use both monthly and annual data, and that's based on what's available. But we have this problem, which is that most sort of political data, and actually it's economic policy outcome data as well, is available on an annual basis, occasionally on a quarterly basis, things like inflation or some budget deficits. And so as a result, we're left estimating models of either monthly or quarterly or annual interest rates. But if we know anything about capital markets, we know these move in a much shorter term way, right? So ideally, we'd be looking at sort of daily changes in risk premiums, which of course we have lots of data for that, and thinking about how these line up with sort of what your peers are doing and what's going on in your region. So one issue here is thinking about debt that is data that are more fine-grained. Of course, the other thing that people in political science are very attuned to these days is that observational data in general has lots of problems to it, right? And so it's like, how much do we trust statistical analysis to really give us a sense of what's going on? It shows us correlations. If we have a good causal theory, maybe that's enough. But the other way to think about this is maybe doing some survey research to get a sense of how professional investors are really making decisions and how these country categorizations play a role. So one of my co-author and I are working on doing a survey of professional investors, a web-based survey, in which we ask professional investors to evaluate countries. Pretty straightforward, if we can get them to do it for us, right? To take their time to do our study and not be making money instead. But anyway, we ask them to evaluate countries, and what we vary is the peer group in which the country is presented, right? So we present Brazil in the context of other BRIC countries, or we present Brazil in the context of other Latin American countries, and we see on average, right, how much that treatment in terms of how you frame Brazil, okay, matters for assessments. Now, of course, a country like Brazil, we think investors are going to have a lot of preconceived notions or just information. So it may be hard to get much of a result from manipulating things in this way, but we think it might be a fun way of figuring out how these categorizations make a difference. So coming back to my 3 lessons from the crisis, this third one here, and our work on this so far, suggests that, again, the ways in which countries get categorized or get grouped, and the ways in which these groupings change over time, which I haven't said much about, but I gave you the Greek example, could be really important determinants of government's capacity to access markets. It's a lot of information. I've realized now that I can talk about debt all day, which may not be a good thing for all of you. But in any case, I'd be happy to take your questions or comments on anything, or to show you more slides that I happen to have.
Yeah, so how would you assess a country like France, which regionally you don't, some people say, okay, is it Southern Europe, is it Northern Europe? Economically, you're not really sure. Is it closer to a Germany, is it closer to a Spain? So what would you say about a country like that?
Well, I would say that professional investors, I think, would tend to put it in the core of Europe, right? And so not peripheral Europe, right? Especially not now that there's really this distinction that's opened up between peripheral Europe and the European core. Were there worries about the French election, right? Yeah, sure, there was talk about, what does this mean, in terms of Hollande being a lefty, right? But I actually think that part of the sort of investor concern about the French election was less about what will this mean for the riskiness of French assets, right? What will this mean for sort of government spending in France? I think it was more about what is this going to mean for the dynamic between France and Germany, right? So I think a lot of the concern about the French election was, not we don't trust the left for French policy, but we don't know how this is going to play with Angela Merkel, right? So we don't know sort of negotiations about what to do with the European Stabilization Fund, right, or what kind of bailouts in general. What will this do? Is that it?
How closely do investors look at credit ratings and credit agencies, and how do you still have legitimacy after
That's a
your
great
crisis?
question. Right. So sovereign credit ratings agencies. I guess one thing I should say is that the agencies that rate sovereign debt rate other things as well, right? So they're rating corporate debt, often banks, and so there are 3 big ones, right? Moody's, Standard & Poor's, and Fitch, and they came under a lot of heat during the financial crisis. Not so much about their sovereign ratings, but about their ratings of banks, right, and of various assets, right, but the criticism was kind of the same one that you might level about sovereign ratings, which is to say that if the rated entities are the ones who pay to get ratings, right? So if you're a government and you want to get a sovereign credit rating, you pay the rating agency to rate you. So the concern, right, is that if you're a corporation or issuing debt, so the concern is that there's this financial incentive to not be too hard on the person who's going to pay you, right? And so one of the worries is like, well, to what extent are they really being objective about this, right? And of course, there's also, it hasn't been historically much regulation of these ratings agencies. And so what the data suggests is that sometimes sovereign credit ratings agencies will see things coming, right? That is, they'll look out at France and they'll say, oh wait, we see trouble brewing. We're going to downgrade France from AAA to AAA minus, right? And then trouble happens, right? So they do what they're supposed to, right? That is, they're looking at things and they see increased investment risk, and then it plays out that risk has increased, right? But the trouble is that in a lot of instances, what happens instead is that they are very rosy about things, right? They don't change their rating. Suddenly, bad news happens, right? And then the credit ratings agencies revise their ratings, right? So one of the issues here is the idea is that they're supposed to sort of help predict what's going to happen, but they often end up following what happens, right? And so some studies of this I've seen suggest that about half the time their ratings changes precede policy changes, but half the time they follow policy changes, right? So they're not, which gets to your question of like, what are these people doing, right? But the way that things are structured, most professional investment funds can only hold sovereign bonds that are rated. And usually they can only hold sovereign bonds over a BB minus rating, right? That's the cutoff for what's known as investment grade. So pension funds, for instance, have to kind of get, right? So if you're a government, you have to get a rating, right, if you want to make your assets available to a broad pool of investors. And even if you don't like what the ratings agencies are doing, you're gonna at least get a rating. The credit ratings agencies are pretty tight-lipped about what drives their ratings. They won't kind of give out their methodologies, but they say that they're in the business of assessing ability and willingness to pay. And so, things like inflation and budget deficits, those are good predictors of ratings outcomes. Political factors sometimes are, sometimes aren't. So, for instance, we sometimes see ratings get downgraded in the pre-election phase because there's a concern that governments are going to try to expand the economy before the election to sort of win re-election. But it's not, there's a less systematic relationship between ratings outcomes and political factors is what I find. I'm not sure that's much. Yeah, so the answer is I don't know how they're still in this.
Maybe this is kind of an obvious question, but have you gotten feedback from actual investors about the conclusions of your research? Have they been like, you're right, this is how we make decisions?
So that's a completely fair question. So for my first project was this book about financial market government relations, and I spent a lot of time interviewing professional investors. And then also doing some survey research with them as well. So trying to sort of get I mostly interviewed investors in Frankfurt and London, and then I did sort of survey work to kind of deal with the sort of New York population, as it were. Although one of the things you find out, right, is that it's not kind of the same people, right? Like if there's a transnational community, right, it's investment professionals, right? So I would be in Frankfurt and go in and start to speak my German, which was not that great anyway, and it'd be someone who was actually French who lived in New York for 3 years, and it's like, why are you speaking to me in German? Right? It's like, well, because we're in Germany. No. So, but in any case, so I spent a lot of time with professional investors in that context. We've done a little bit less so far with this one in terms of, so some of the category stuff actually is stuff that comes out of that old project. We haven't gone out very systematically yet to talk to investors on this one. We sort of know a few people in the industry who kind of think this is generally right, but obviously some more systematic sort of qualitative work would be a good thing to have. Absolutely. Yes.
It's a counterfactual question. If the US and Japan, with its deficit numbers and annual deficit and budget deficit numbers, were part of the European Monetary Union, were Euro members, would the US look like Ireland and Spain because it had to take on lots of private debt through the financial crisis and has lots of foreign borrowers? And would Japan look like Italy, since it has 200% something of GDP to debt ratio, but most of the debt is held, as you say, by resident borrowers? And if so, and I would say yes, I would say the US would look like Spain, Portugal, and Ireland, and I would say Japan would look like Italy. Why don't they? Why don't they look like Spain, and why aren't they talked about it like Spain or Italy is talked about? And the reason I would argue is the euro is sui generis, as you have heard so often about the European Union. It's unprecedented. There is no currency like it because it's not a sovereign currency any longer. Japan, the US, have no default risk because the central bank can and do print the money or engage in quantitative easing, in buying government debt. It might be against the statutes of the Bank of Japan and the Federal Reserve and even the Bank of England, but they still do it, right? And every investor knows it. You might get inflation, you might not get 100% return, but they will not pay anything back, total default. This risk is zero. The European Central Bank, of course, could do the same, could go above the statute, their own limitations. And this is actually what Draghi did, the central president, by saying, well, we will do it, we will do it. But for an investor, if you know that's a currency where 15, 16, 17 sovereign countries would actually have to come together to change the law, to give the central bank the power the Federal Reserve has, the Bank of Japan has, the Bank of England has. They are just subject to national law. They are just born out of national law, which you can change as a national sovereign. If you have a central bank that depends on 15 or 17 sovereign nations, if you want to change the games it can play, quantitative easing, that's a different game. It's a different game. And that's why I would argue you cannot compare the euro to the dollar or the yen or the pound, because it is not a sovereign debt currency any longer.
Well, in some ways, I think what you're getting at is that there's not a common fiscal authority, right? I mean, I think that this is part of the story, right? That you have fiscal rules, but you don't have any sort of EU-wide fiscal policy, right? And that's, that was something that was pointed out for a long time, right, before EMU, right, that this was potentially an issue, and it comes to be. But, what your comment makes me think about, however, is that, maybe the relevant comparison then is not how other sovereigns are evaluated, it's how state-level debt is evaluated, right? So think about sort of, right, there's been a little bit of work, not a lot, right, about U.S. state borrowing, right, sort of what drives the premiums there. Where, again, the U.S. federal government says we'd never bail you out, but again, it's not clear they would, right? We have Brazilian states, right, some of which, many times, right, went into default, right, and sort of got themselves and got all of Brazil in trouble. So we have other instances, right, where sort of subnational political entities engage in borrowing and then sometimes get into trouble. One difference, of course, is that most U.S. states have balanced budget amendments, right? And so some sort of requirement, right, to have fiscal balance, right? And so I think it's easier then for the U.S. government to sort of say we're not going to bail you out because they figure they're less likely to be pushed toward that. You probably know this, right? But the Japanese government debt is also very long term and almost entirely to Japanese sort of consumer investors, right? So maybe they are actually Italy, just with different food or something like that. I think the other way to argue this, though, is I think the U.S. is sui generis, right? I mean, I think the U.S. gets away with an incredible amount in terms of how much it can borrow, right? And in terms of having big fiscal deficits. And I think this is largely not, this is a story about having a key currency, right? And so, one of the things that's true over time is that the holdings of euro assets in central banks and as foreign currency reserves have gone up over time, right? But it hasn't got anywhere near replacing the U.S. dollar, and I think and the crisis, of course, I think has kind of put the damper on sort of further parity there. But the desire of foreigners to hold U.S. denominated assets, right, especially sort of quote unquote safe treasury bills, right, means that the U.S. is still the kind of flight to safety or flight to quality location, right? Investors who get nervous about Europe, where do they come? To the U.S., right? Which is like, kind of annoying if you're a reasonably solvent European government because it's like, we're no better, right? So if we look at our sort of, deficit and debt numbers, we don't do any better than many of the European governments. But I think part of the story is the EU is unique. I think it's also the U.S. is unique. And again, I mean, to come back to this, the many holders of U.S. debt, right, are not these private investors, right? They're these foreign central banks. So like after the Asian financial crisis, the governments of Southeast Asian countries really wanted to build up their own reserves, right? They didn't want to get in trouble and have to go to the IMF again. They decided they would kind of self-insure. And so part of self-insuring is accumulating these really big dollar reserves. How do you do that? You buy U.S. government debt. So I think that there's a demand for U.S. assets part of the story as well. You follow? Yeah.
I'll clarify. I mean, the uniqueness of the U.S. is because it's a reserve currency, but so is the euro. If you look at the makeup of the central banks, it's not as important. But it's certainly more important than what's the German mark or the British pound or the yen or all of three of them together combined, right? So it's really why the uniqueness is that the dollar is the only currency for commodity trade. If you want to trade in commodities, oil and copper and coal, you need dollar, and that's I think what really makes it stand out. Fiscal union, that was part of your answer. This would be another uniqueness. I was just talking about the monetary union and the impossibility of the central bank to do quantitative easing, something that London did, that Washington did, that Tokyo did. And this is what drives the euro crisis. If you go to fiscal union, if you say the Stability Pact, 60% GDP and 3% annual deficit limits and stuff, this would be another totally unprecedented something for currency. There is no currency out there that has fiscal limit. The US government, the Japanese government, the British government, they do not have any laws against or have any set limit. They can borrow indefinitely. If you say you can only have a total debt of 60%, this is unprecedented in currency history, as far as I know. So then you would introduce actually a second uniqueness. Besides the no bailout and the no quantitative easing uniqueness, you would put another uniqueness in fiscal limits, right? There is no fiscal limit to the British, to the American, or to the Japanese government, what it can do. To the states, yes, to the 50 states, but not to the federal level. And of course, the EU cannot borrow at all. if you want to think as the EU as a federal level. It cannot borrow at all. And now you put also restrictions on the member states. Completely unique, completely unprecedented, and therefore incommensurable. I would argue.
Did I see another hand?
Yeah, I was just wondering, there's been a lot of rhetoric, especially during the election season about the need, how the high U.S. debt is really threatening kind of the fabric of the U.S. economy and our standing in the international community. Do you think that, and something drastic we need massive cutbacks, do you think that a lot of that rhetoric is warranted, or do you think that the high demand for U.S. debt abroad that kind of mitigates that?
Right. So I guess one way to think about this is how sustainable is that demand for U.S. assets abroad, right? And so some people have thought about this in terms of we should worry that the Chinese central bank is holding so much U.S. debt because this gives them political leverage, and I don't buy that very much. I think because yes, that's true, but there are many things that the U.S. could do to China that would harm them, right? So if the Chinese central bank decided to engage in a massive sell-off of U.S. debt, the U.S. could close its export or its import markets to Chinese products, right? So it's like they need us, we need them. It's this kind of mutual dependence, right? So I don't think that's as much of the issue. Well, I think what's more the issue is this question of the extent to which the dollar kind of remains, right, this key currency, either for commodity transactions or as a reserve asset. And this is Barry Eichengreen had a book that came out last year called Exorbitant Privilege, where he argues that although the dollar has kind of been the key currency since the Second World War, there are these challengers, right? And that maybe it's not going to be the euro, maybe it's not going to be the euro quite as soon as we had thought, but maybe it is actually going to be the Chinese yen, right? So maybe it's renminbi denominated accounts, right, that are really going to make a difference, right? So if you think that's a possibility, right, that the kind of general demand, either privately or officially, for dollar-denominated assets is going to decline over time, what that implies is that the cost of U.S. borrowing are going to go up over time, right? And that carrying a lot of debt today is costly, but it might get more expensive in the future, right? So it's like, are people, if suddenly the U.S. Treasury bond is not the go-to asset, right? Even with the same amount of debt, you'll have to pay more to roll it over, right? And that's going to be a constraint. So the other way to think about this is, interest payments on debt, right, are a budget line, right? And so to the extent that you're spending more on paying interest on your debt, you have less to do other things with, right? So I think that's the real concern, right, is that, as that budget line has grown, right, as the debt's grown, so have the interest payments, that does mean that there's less money for other stuff, right? So the only way to sort of, still have money for other things and have rising interest payments is to spend more, which of course means bigger deficits, which of course means more debt, right? And so it's this kind of, it's not the virtuous cycle, it's the vicious cycle. So I think to some extent, that's not just political rhetoric, right? That's a concern about, what are the long-term implications of rising debt, right, in terms of servicing that debt versus doing other things with public finances.
I've actually asked two different economists this question, and neither of them had.
So this is like my chance as a political scientist to show them up.
No, it's not that complicated a question, really. Because the issues in especially market problems right now are both complicated but also potentially kind of boring. Who is the best person writing right now to follow to develop a good understanding of what's going on? Who's writing with both clarity and is also kind of interesting?
What do you follow what?
In terms of understanding the euro crisis, understanding the housing bubble and all these other different things that have occurred. If I, as someone who does not necessarily have a deep background in terms of economics and can't just look at the numbers, and then perceive them like looking at the matrix or something like that, who do I read?
Yeah. So I have to say, I tend to be, I'm not sure the word is lazy or set in my ways or old, but I tend to read The Economist. I mean, not economists, but The Economist, right? At least to get a sense of kind of the blow by blow, right? Yeah, they have a certain ideological lean, but I think they're pretty good about separating out their editorial content from their sort of this is what's going on content. I also tend to, you could read the Financial Times, right? You could sort of use sort of news sources like that. I don't know if you've seen it or not, but I like I like Danny Roderick's actually blog, but that's more about development and the global economy and less about the EU specifically. I also read the Monkey Cage, which is actually more of a political science blog. So a lot of the stuff in the Monkey Cage is actually about American politics, but it's a bunch of political scientists who also kind of get other people they know who are also usually academics to contribute. So they have a nice and Henry Farrell, one of their people who runs it, is a sort of IP person, and Josh Tucker, who's a kind of CPE person. So they tend to have some good content. They do a nice job of aggregating things from other places. And I sometimes also read Dan Dresner's blog on foreign policy, and Dan is probably more of a conflict person and also more of a sort of a realist from the point of view of those old ideologies of international politics. But he also, I think, he also has a background in economics and does a nice job of kind of bringing together the political economy stuff.
Yeah, so back to the idea of purchasing debt or purchasing a bond within a country relative to outside of the country, resident, non-resident. Would you find, if you were to do research, that the greater percentage of people within a country that hold their own country's debt, would you find that is better for the economy or worse for the economy, or does it even have an effect at all?
I don't know what it means for the economy. There's some anecdotal work, I haven't looked at this systematically, but some anecdotal work that suggests that when your resident investment is higher, then there's a less drastic and a less pronounced response to sort of things like political events, right? So if there's an unexpected vote of no confidence in the government, right, the coalition collapses, that'll have a bigger effect on the country's bond prices when it's a lot of non-resident investors than when it's resident investors, right? And so, what does that mean for the economy as a whole? Well, that depends sort of what those short-term movements in the capital markets mean, right? But in terms of sort of government borrowing costs, it does seem that resident investment affords governments with a little bit of insulation from the kind of short-term market reactions, right? I don't know whether resident investment affords you more insulation from kind of longer-term market reactions, right? So one question would be, to what extent are countries that have more resident investment, do they sort of pay a lower premium for having a large government debt, right, than do those who have more non-resident investment, right? So the other way of putting this statistically is, to what extent is the effect of debt on interest rates conditional on resident investment? And I don't know the answer to that, but one could certainly find out.
Anyone else?
Thanks.